The Retirement Cafe podcast, seeking compensation for negligent financial advice with Philippa Hann. Hello and welcome to this week's episode. It's great to have you here and I'm delighted to welcome Philippa Hann as my guest today. Now this is a conversation for anyone who's read about the numerous pension and investment mis-selling cases that have hit the headlines in recent years. By the end of this conversation, I can assure you that you will have gained insight into the world of negligent investment advice, as Philippa is a leading figure in this field. She's a lawyer and partner in the financial services litigation team at Clarke Willmott, where she specialises in the mis-selling of investment products and negligent investment advice. Philippa has significant experience in acting for and against financial advisors in consumer complaints that have been made to the Financial Ombudsman. You can't have failed to hear about the defined benefit pension transfer mis-selling scandal that affected many ex-British Steel workers. Philippa shares her experience of working with those affected with us today. And we also touch upon how the Financial Services Compensation Scheme works, what to look out for if you feel you've received negligent advice, and the benefits of taking advice versus going solo. I hope you find this conversation as informative as I did. Welcome to the Retirement Cafe podcast, Philippa Hann.
Morning, Justin. Lovely to be here.
Yeah, well, thank you so much for joining me. We last saw each other a week or two back at Red Bull Racing for the CZ Chartered Institute Securities Investments Conference, which was really good, wasn't it?
It was.
Now, you're not a financial planner or financial advisor, even though you hold some qualifications. You're a litigator. You help protect. You work for Clarke Willmott LLP, which I think are in Bristol. Is that right?
We're in 8 different cities across the UK, but our head office is in Bristol. Yeah.
Head office is Bristol. Whereabouts are you based?
So I'm based in Bristol. I'm sat in Bristol at the moment.
Marvellous.
Yeah, not in the office. Well, in my office at my house.
So, what does a financial services litigator do?
Wow. Okay. So I've been specialising in financial services litigation for, coming up almost 20 years now. What do? I either act for financial advisors or I act against financial institutions where something has happened with an investment that possibly shouldn't have happened, or someone's been disappointed by something that's happened. So I generally try and assist people who are seeking compensation for professional negligence around financial advice.
Now, there can't be much of that, surely.
Do you know what? I first started this back in 2016. 2006. And then we had RDR happen, didn't we? Where the regulator came in and said, right, we need to increase the standards of financial advisors or planners in the industry. And they changed all of that and they outlawed various types of commission, and they required everybody to take new exams, which I did take. Because I'm dual qualified as a solicitor, as you say, and a financial advisor, albeit not authorised, and I would never advise anybody. I did think to myself, will these claims come to an end? And no, they have not. Frankly, I've never run out of work. So we've been from the pensions review back at the end of the 90s, and I caught the tail end of that when I was first doing this sort of work. Then we moved into the banking crisis after the problems there. Then that was many years of litigation falling out of that, where people who thought they'd been in investments which were not as risky as they turned out to be. They lost a lot of money, bad things happened, so worked for a lot of people there. And then it is the sorts of sort of funky advice that people get. So maybe film schemes, or we did a lot of work around Premier Access bonds, and it tends to be a theme. There tends to be a theme of things that happen. So key data, arch crew, Connaught, these sorts of products that people are advised to invest in. They don't necessarily understand what they're investing in. The advisors don't always understand what they're advising their clients to invest in. things happen that people hadn't anticipated. People become disappointed. They lose money. They come to me and say, I've tried. I can't resolve this. I need someone to assist me in pursuing it going forwards. And about 3 years ago, I met with the first lot of British Steel workers who had been transferred out of their final salary pension scheme. And 3 years down the line, we are still working on that project. And we probably have about 1,000 clients who were transferred out of the British Steel pension scheme. So that's our current project.
Gosh. So there's a few things to unpack here. There's a number of things I'm thinking of. I'm thinking of, well, RDR, then the retail distribution review, removing commission, getting advisors qualified, doesn't seem to have helped on that front. Or maybe it has, but maybe not as had a bigger impact as hopefully the regulator would have wanted. Then I'm also hearing, so advisors are recommending kind of products that are a bit, as you quite rightly say, kind of funky, but the clients must have some kind of demand for that, I suppose, to say, you know, I actually want this type of product. I don't know why, but maybe they do. I don't seem to find that with people who approach me, but so there's something going on there. Then, of course, the other aspect of, well, if something's gone wrong, there are some processes, aren't there, you know, with a Financial Ombudsman service, financial services compensation scheme, for actually people not to come to you. You know, there are some kind of, some procedures that they can follow without getting a lawyer involved. So let's take a step back and look at those one at a time, if we may. So the demand for the funky products, you know, is that a sales-led thing, do you think, from advisors, or is it a demand from customers?
I think my experience, and of course this will have to be a bit of a generalization because everyone has their own story, but my experience when there is, as I said, you know, there are themes around these sort of funky products. So, for example, taking the AIG Premier Access bond. So right. That was a bond which was supposed to be as safe as cash, but gave you access to the money markets and therefore would give you a little bit more return. And the types of clients that I had who were invested in that tended to be of a type because the bank who was advising them would put people into boxes. So these tended to be owner-managers of business who'd sold their businesses, worked very, very hard all their lives, suddenly come into a huge chunk of cash, and had quite rightly gone to see somebody to say, look, I have never had this much money before in my whole life. This isn't money that I've built up slowly over the years. This is suddenly millions of pounds that I'm coming into because I've sold my business. So they sort of sit into one box, and the advisor said, aha, we have a product that will suit you for that. So there's that sort of thing. So they weren't looking for a funky product. They were saying, these are my circumstances. I suddenly need this advice because I've come into a big lot of money and I don't know what to do. So you have those people. You have people who were saying, well, I want to beat what I could get back from putting it in cash. Who doesn't these days? And they're looking for a little bit better return. And I think in those circumstances, there is a missing conversation between the client and the advisor, where the advisor is being absolutely clear about what is possible and what is not possible. So there are some advisors who will take orders from their clients as opposed to sitting down and saying, all right, I get that you want a unicorn. I can't give you a unicorn. This is what I can do. And of course, perhaps those advisors hadn't properly understood what the product was, so what the Arch Crew product was, for example, and had not done the due diligence that they ought to have done, or perhaps thought through exactly what the problems could be in the future so that they could discuss the risk and reward with their clients. And let's be absolutely clear, there are no unicorn products out there. You know that, Justin, I know that. And anybody who tells you that there is this magical product that will do everything for you is confused about what the risks are. So that is, I don't see scenarios where clients are walking into an advisor's office and saying, give me 10% return without any risk. That doesn't really happen. You do get clients that walk in saying, this is my issue. I would like something to solve this problem, and it's been solved wrongly. Now, when things go wrong, it's not necessarily because the person who's made the mistake is a bad person. That's why we have insurance. Solicitors advise wrongly, doctors advise wrongly, accountant, because we're human. So this isn't necessarily about people behaving badly. This is just mistakes. This is just bad advice. But from my perspective, and my experience of doing this for the amount of time that I've been doing it, and one of the really interesting things about my job is when we get hold of the file from the other side. So client will come in to me and I will say, right, well, we need to get hold of your file. So the first thing we do is go to the financial institution and say, here's a subject access request. Please provide us a copy of the file. That is interesting. But what is more interesting is when you go through the litigation process and you then get what's called disclosure. And so disclosure is an exchange of documents, these days mostly electronic, where any paper that they have or any document that they have which either assists or detracts from their client's own case or vice versa in relation to my client's case, we exchange those. So I will see the emails that pass internally between the advisors or the advisor and their boss or the compliance department and the advisor, and you would be surprised at some of those emails. So for me, some of this is down to the culture of the firm that the client is talking to. So we had a bank, for example, where the remuneration strategy was such that the people who were selling the products would get a lot of money if they sold a lot of those products, and that drives behavior. And even if the remuneration strategy of the firm is not to reward on the basis of the amount of products that are being sold, but actually even if they're getting a slap on the back, well done, Nigel, you got another one through, doing an awesome job. You know, the Newcastle office is beating the Manchester office. That sort of culture, where it is a status-led culture as opposed to a relationship-led culture, in my experience, can lead to some unfortunate behaviour, which then the consequences of that are client losses.
Yeah, absolutely. So, it's, I've been in this business, I think, sadly, longer than you. And you trotting out those names of Arch Crew and the AIG product and the previous pensions misselling, all of a sudden they're all coming back to me. I started with my first regulator was the IBRC, and then it was then it was PIA, I think, and then it was the FSA, and then of course the FCA. So I've gone through and I'm suddenly remembering all of these mis-selling scandals. It's been continual, hasn't it? And of course, this is not just repeated in the UK. As you talk about the banking sector there, I remember, of course, the American bank who were didn't they go bust purely because they've been selling all the wrong types of bank accounts? And the whole sales culture was all about bonuses, and they were lying about how many accounts they've been selling, and they were opening up accounts in people's names that didn't exist. And, you're right. I think it is about a cultural thing, isn't it? I then wonder, and I look at my own little business, and I think, or the business that I've been in, and I think, well, why haven't I got into this kind of pickle, myself? And I think it comes down to that clear thing that you said before, which is, first of all, we have a culture here of really trying to serve our clients well. But second of all, if I don't understand something, I don't advise on it. If I don't understand the unicorn product and how they're actually managing to, pay 4 times what the base rate is doing in a cash deposit bond, then if you kind of go looking at that and go, well, I don't understand that, then surely that's not a place to put my clients.
Yeah. I mean, for me, it's all down to the culture and the purpose. The conversations around purpose. How many firms are having conversations around the purpose? Why do we get up in the morning? Why do we come to work? And I don't believe for most people it's the money. I really don't. Once you've got enough, it's not about the money. It's about the pride in what it is that you're doing for people. Yeah, and I always say to my team, we fight the corner of people who cannot fight for themselves. That's what we do. And that is a phrase that we repeat over and over again. And that's a good thing. You know, it feels good to be doing that. And so I think that's right, where the purpose of the financial advisor is changing lives for the better, or whatever that purpose might be. I suspect the conversations around the funky products just don't happen.
No.
Because nobody's trying to prove anything other than they've changed their clients' lives for the better. And I truly, you know, despite the fact that I've spent quite a lot of my professional career seeing bad advice, and you do care, you do get emotional, you do get upset for your clients, you do want them to have the best, and it is upsetting when you see that they've really just been used as a cash cow. I had one internal email that I saw through a disclosure process where one advisor was saying to another, "Oh, give insert name of my client a call. I could do with another holiday this year." That sort of thing's really deeply unpleasant.
Yeah.
I lost my train of thought there. But I you know, where you're having conversations around why we do this, rather than how much of it that we do, I think is, for me, it's about, it feels nicer. I don't know how many other people you've ever worked for, Justin, but I mean, I've worked in various firms. I mean, I've been a partner here for a while, but I worked in 2 other firms, and the question I always ask financial advisors who I work with on that sort of culture side of things is, what is your Sunday night feeling? You know, how do you feel about going into the office on a Monday morning? And I don't know about you, but I've certainly had a Sunday night feeling of anxiety or dread or just general uncomfortableness around going into the office the next day and worrying about that. And then I ask myself, you know, what are the behaviors of the people that I'm working with that drive me to feel anxious about going into the office? And I realize it is because there is, you know, finger pointiness, there is a blame culture, there isn't that greater purpose around helping people. And in those firms I left. That's what I had to do. And I think if people are feeling that Sunday night feeling around whatever job it is that they're doing, be it financial advisor or something else, actually that probably isn't the firm for you. And I think this is far more about culture. When we try and protect people, when we look at bad things happening, this is far more about culture than it is anything else.
Yeah. So obviously, you know, you went the massive headline figure of 1,000 people or 1,000 clients that you're working with on the British Steel scenario. And I want to move to after this to, you know, what we can do about protecting people and also how the kind of claim service works and that type of thing. But just unpack for me what's happened with British Steel.
Okay, so it's a really interesting story. It is a perfect storm. It was a perfect storm. So we had the British steel industry declining. And so from a pensions perspective, you've got lots of people who are moving into the pension and wanting to draw an income from that pension, and fewer people paying into the pension as employees of the steel company. So British Steel could see that further on down the line, as the steel industry in the UK declined, there would be fewer and fewer people paying in, more and more people retiring, and a greater demand on that pension fund, and at some point in the future they would become insolvent. So they quite rightly spoke to the pensions regulator and said, look, this is going to be an issue. And the British government went out and they did a consultation about what they were going to do about the British Steel, because it's one of the biggest final salary pension schemes in the country. So they went to a consultation and said, right, what do we do about this? Do we allow it to fall into the PPF? Do we seek to decouple it from the company itself so it's a standalone pension? Do we allow people to transfer? What do we do? So they they got to a point where they did what they call a regulatory apportionment arrangement. So they allowed British Steel to decouple that pension scheme from the company to put it to have it as a standalone. They then went out to 42,000 active members of the scheme and said, you have 3 months to make a decision. They called that the time to choose period. And they gave 42,000 steel workers a lot of information, but said, we can't advise you. If you are unsure, you need to go and get advice. And you'll know, of course, that you can't just advise somebody to transfer out of a final salary pension because they are so valuable. And in fact, as a financial advisor, you need to have additional qualifications and additional permissions from the regulator in order to advise on this very specialist area. So you had a lot of tens of thousands of people who were financially unsophisticated. And I mean that in a not a critical way. Most people out there are financially unsophisticated because they've never done the exams. Why would they know?
And of course, the whole idea of the final salary scheme was that the employer was looking after your pension arrangements. So therefore, and it was an easy to understand, i.e. you will get a promise of a certain percentage of your final salary when you retire. So that's the whole concept is great. I mean, it's amazing. It's fantastic. And it's easy to explain. And therefore, if all you've got to understand about pensions is, well, I'm going to get 2/3 of my salary when I retire, that's all you need to know, isn't it? And oh, by the way, if I die early, my wife gets half of it, or my spouse, gets half of it. So therefore, we only spend time investigating and learning about stuff that we need to learn generally, don't we? We don't, or we're interested in. And you and I are interested in pensions, but probably we're in a very small slither of the population who are. And therefore, of course, all of a sudden, we've got a whole different thing to think about. It doesn't matter how clever you are, that you've got 12 weeks to become really clever on pensions.
Yeah, and it's complex.
There begets the problem.
Yes, exactly. And
so you seek advice.
Exactly. So you seek advice. And of course, they'd had a long period of things changing. And it used to be that they could retire at 60 without any penalties. And then that changed to 65. And so it just felt like a little bit there was things being chipped away from them. And when things are being slowly taken away from you and you don't necessarily understand it, you feel a bit resentful and you feel a bit negative towards whoever it is that's chipping away at the things that you thought you would have. So you had tens of thousands of steelworkers who were seeking advice. You had those people in in areas of that weren't particularly affluent. So you had advisors working in areas of some social deprivation, and the opportunity for these advisors to do a lot of work. And these transfer values, so what would happen is that the steel worker would say, right, well, I will be entitled to, plucking figures out the air, £20,000 from age 65. And if I transfer out, I will get a lump sum. And so that lump sum may be £400,000, for example. And if you are earning £35,000 a year and someone offers you £400,000, humans are very bad at understanding the value of an income versus a lump sum. We can all see a lump sum and say, wow, that's like winning the lottery, £400,000. I've never dreamt of that amount of money before in my whole life. Whereas actually, £20,000 a year for the rest of your life is worth a heck of a lot more than £400,000. But it's very difficult to see in that moment because £400,000 is a lot of money. So we had this perfect storm where a lot of people were distrusting their advisor. They were not understanding the value of an income versus a lump sum. And there were a lot of advisors who could make a lot of money in a very short period of time. And perhaps they hadn't been making quite as much money as they would have liked to over that period. So we had a proportion, about 7,500 steel workers transferred out of the British Steel pension scheme. And most of those should not have. I would estimate that probably 90% of those shouldn't have transferred out. And most of the time they were being advised to transfer out for flexibility of income, which to my mind is simply nonsense. frankly, if you've had an income throughout your life, why you would want an income that isn't the same throughout the rest of your life in retirement, I have no idea. Death benefits, and as you rightly said, Justin, the death benefits for a final salary scheme is usually a 50% spousal benefit. So the spouse would get 50% of that income for the rest of their life, and they wouldn't have to speak to a financial advisor, and they wouldn't have to look after it, and they wouldn't have to budget, and they wouldn't have to worry about it. So there was flex, death, and the potential of an early retirement, which I totally get. But actually, let's not forget that they closed the DB scheme, the final salary scheme, and they opened up an occupational scheme, which many of your clients may already be in, which is the type of scheme that your employer puts in a bit of money, you put in a bit of money, and the whole pot grows, but it's you that takes the risk. So they were all starting those as well. So I would have expected there to be conversations with the advisor around, okay, so you would like to retire early, you would like to leave your family with some money, all very sensible. Let's look at how we might do that. So I don't like silver bullets. This unicorn product is going to be the answer to all of your dreams. And it's so rarely the case. You know, there are no silver bullets because we're not werewolves. And so I worry when I see letters of advice from advisors where they haven't looked at different options, where it is just, we'll do this, you'll be fine, send them off into that particular area. It worries me when I see that, and a lot of the time the only thing that was discussed with the steelworkers was transferring out, and that was wrong.
Yeah. Awful. So there may be people listening to this who have been transferred and are now thinking about whether that was the right thing to do, or they may have bought a financial product again which they're disappointed at and feel that the advice that they got wasn't great. What recourse is available to people if they are feeling in that position?
So the first thing I would say is, if you've got a niggle and a worry, don't think I'll do that later. Don't think I'll worry about that next year. I'll see how it pans out, because there are time limits that you need to be aware of. So ordinarily, it would be 6 years from the date of the advice. So if you were transferred out 5.5 years ago, 4 years ago, don't delay, or there was a product that's been niggling you and you've been worried about it for a while, you need to do something about it sooner rather than later. So the avenues that you have are either to go through the Financial Ombudsman service, or if the person who advised you is no longer trading, they're no longer solvent, you would need to direct your complaint to the Financial Services Compensation Scheme, or alternatively, you can use court proceedings. Now, I would ordinarily be very careful about going forward with court proceedings, because as you can imagine, they can be very expensive. So usually they are for claims where the losses are much larger. So the Financial Ombudsman Service can direct compensation payments of between £160,000 to £350,000, depending on when the bad advice happened. And the Financial Services Compensation Scheme, generally, depending on what the advice was, what the product was, it's around £85,000, again, depending on when various things happen. So there are caps on the amount of compensation that you can claim, but the Financial Services Compensation Scheme is a free service, only to be used where your advisor is no longer trading. And the FOS is also a free service. And no, you do not need to have a claims management company charging you 40% of whatever you get back acting for you, and you don't need a solicitor. The only thing I would caveat that with is the way that it's dealt with is not always correct, and so you can have value added to the process if you use a legally qualified entity. So what we have seen, actually when our clients first went to the FSCS in relation to one of the British Steel defendants, the FSCS had simply calculated the damages wrongly. And we were able to pick that up. And also, if you don't understand why the advice was wrong, are you going to be able to put your best foot forward in terms of putting that together if you are pursuing compensation? So there are upsides to using professional advisors, as well as downsides. And the downsides is, you have to pay for it, but you do not need a solicitor or a claims management company to use those two avenues, but you would with court usually.
And of course, if an advisor is still in business, that firm should also be maintaining professional indemnity insurance for poor advice.
Justin, you're getting me on my hobby horse here. Yes. Now I have a problem. I have a big problem with the PI insurance in the financial sector. I think it is inadequate. And I look at the minimum standard professional indemnity insurance that I need as a solicitor or an accountant might need, and I compare that to the minimum term insurance that a financial advisor needs, and they are miles apart. So a lot of the financial advisors that we are bringing actions against in relation to the British Steel workers are falling insolvent. And that is because financial professionals are allowed to have exclusions written into their contracts of insurance. So when these advisors gave the advice that they were giving, for example, on the British Steel thing, so they were absolutely qualified to, had permissions and the insurance to advise people on pension transfers when they gave that advice. As soon as the problems occurred, the insurance companies were sat there crossing their fingers, waiting for the insurance year to come to an end so that the following insurance year they could exclude liability for that advice. Now you might say to me, but surely because they were insured at the time, they can just go back to that original insurance. No, they cannot. The way that most professional indemnity insurance works is that it's on a claims made basis, and so it is the insurance year that you are in when the claim is made which responds to that claim. So it doesn't matter that you were fully insured at the time you did the advice, it is what your insurance says as at the time the claim is made. So as a solicitor, I cannot have exclusions for any of my past business. So for me, it doesn't really matter. So if I wouldn't do it personally, I wouldn't do conveyancing, but if someone in my firm and they did conveyancing or a merger or a divorce or whatever it is that they've done from a legal perspective, I am assured because the Solicitors Regulatory Authority has required solicitors to have qualifying insurance, and that qualifying insurance means that we cannot have exclusions. We also have to have a minimum of £3 million worth of insurance per claim, which means that, we have a lot more, but that means that we don't run out of insurance. We're not put in a position that perhaps a financial advisor might be put in, and I've seen an advisor put in where they've done some work. It may have been key data, it may have been arch crew. I've seen those excluded from insurance policies as well. And the following year, when they get the claim, they don't have any insurance for it. So who pays? Well, the firm pays. Now, if they don't have, however much the compensation is worth, then that company goes under. That company goes under, the claim then moves to the Financial Services Compensation Scheme. And who pays for that? Justin, you pay for that, along with all the other financial firms out there who pick up the tab for those companies who've gone insolvent. Now, I've spent some time looking and trying to work out how we solve this problem, because if you're required to go to the FSCS, your compensation is capped. So I've had clients where their compensation ought to have been hundreds of thousands of pounds, but their compensation is capped at £85,000. That would not be the case if proper insurance were were in place for that financial advisor. And I have a lot of sympathy for those financial advisors because, as I said before, people make mistakes.
Yeah.
Bad things happen. That's why we have insurance. But that's not necessarily the case for you. So I spent a bit of time looking at, so the solicitors have the same compensation scheme. We have the SRA compensation scheme, you have the FS compensation scheme. In the same period, 2017 to 2018, the Solicitors Regulatory Authority compensation scheme paid out £17 million. The FSCS in the same period paid out £450 million. It's night and day. It shouldn't happen. And it is the regulator's fault. It is within the regulator's power to change this, but they have not done so. And they leave you at risk, and they leave clients at risk, and they leave the industry and the economy at risk because people are losing money.
Yeah. Now, you're right in saying that people do make mistakes. But I look at a number of those ones you've mentioned before, and I'm kind of going, well, I didn't make those mistakes. And I'm not trying to be, I'm better than anybody else and that I can never make a mistake. But there is an element of, again, let's invest in things that we really do understand. Let's be absolutely transparent about what we're charging people, what the risks are, and that we understand. And you're right saying if I don't understand, I absolutely mentioned before that I know that there are some schemes out there where you can invest in solar farms or wind farms or all types of things. Well, with all honesty, I have no idea about a solar farm. I could go and have a look at it, I suppose, and see a load of solar panels, but I still wouldn't know whether this was going to be profitable, whether this was going to be well run, whether the price I was paying for it was the right price. And again, if I don't know, then my clients definitely don't know, unless they're obviously experts in solar panel farms. So we've got two things going on here. We've obviously got to get advisors to be really put their hands up and go, what do I understand and what don't I understand? And let's put stuff I do understand in front of my clients. And then the other aspects of, clients, please be aware that ask some really good questions about something that has been put in front of you. So really pertinent kind of like, how long has this been around? Show me how you've done your due diligence on this thing that you're recommending. The other thing on the insurance aspect is, I've gone through I used to be a pensions transfer specialist, and then the insurance company then went, we want to charge you this kind of crazy amount of money. And it was like, well, that's a business case I don't want to do. I don't want to be doing, the price that they wanted to charge me was just nuts. So I just said, okay, well, I won't do that any longer. I don't need to do it. I only needed a few cases anyway. And so no problem with the advice I've given, and I do maintain cover, run-off cover for the advice that I've given around those products, etc. But of course, I am at the whims of the insurance company. If the insurance company turn around and say, no longer do we will cover you for those past advice, then I'm in trouble. So therefore, that is an issue. But there is, when you mention that compensation limit of 450, is it 450 million you said that was paid out?
Yeah, but this year, the last annual report I saw, this year will be 550 million.
Which, first of all, is an horrendous amount that we need to somehow stop, and we can maybe just by getting somehow stopping advisors recommending unicorn products. Second of all, getting clients to be a bit more astute at the types of questions that they need to ask. But also, if I was an insurer seeing that level of liability, I wouldn't want to be an insurer in that market. Is it uninsurable?
Well, the thing about pension transfers specifically is that it can cause catastrophic losses. So if you tell somebody to invest in the wrong ISA, or you get taxed something wrong, it's usually not going to be life-changing amounts of money. But with a pension transfer, as I say, people are very bad at understanding the difference between a big lump sum of money and an income. And some of my clients, I mean, they are outliers, but some of them will have losses of over £1 million as a result of transferring out. So you've got that, and I understand at that point why insurers are saying, "Whoa, you know, for your 50 grand's worth of insurance premium, I'm going to be on the hook for £1 million. Ouch! I don't want to be part of that." But my view is that the current structure, where good firms like yours are moving out of being able to advise on certain things which your clients might want to talk about, but you end up not being able to talk about it with them because you're not insured to advise them on it, and then you're casting around trying to find somebody else who can advise them on it, who all the good people again have left the market because they're saying, like, I only did 2 a year anyway at maximum, and I'm being absolutely punished by it. It narrows the amount of good people doing that, and so it has the knock-on consequence that nobody wants, which is that not enough good people in the market are doing that. So for me, the entire structure of how the financial sector is insured is broken, and it then leads to bad behaviour. And my view is that actually what the FCA needs to do is change the minimum terms and say, right, you won't be in a position where you have to move out of that market because you're frightened you won't be insured going forward. And actually, insurers, you can't get away with just saying, right, we're just not going to insure that because it's going to be too expensive for us. Actually, you need to have skin in the game. Everybody needs to have skin in the game. And so me as a solicitor, I have to meet kite marks. My insurers want me. I get cheaper insurance because I have a kite mark called Lexel, where they come in and they look at all my processes and they make sure that I have that tick box, that standard. They come in for a week a year and they talk to my staff. They say, right, here's a list of staff. I want to talk to these 20 people. You're not going to be in the room while I talk to them because I want to understand how they're feeling about work. It comes back to that Sunday night feeling. I want to understand how they feel working in this firm. Can they, if they see something go wrong, can they talk to somebody about it? And they ask them those questions directly. They look at my policies, they look at my claims record, and there is far greater scrutiny on what I am doing as a lawyer because my insurers demand it. And if the same standards were imposed on the financial sector, then I believe the same rigor would be put around those processes.
You know, Philippa, it was one thing I hoped for. We were the first firm in the UK to get a British standard in financial planning, the BS 8577, and I also held the ISO 22222. And we had the external guys coming in and checking our processes, you know, and it went on for a number of years. We don't currently hold those because, with all honesty, we held it for 3 years or so, and they never found a minor non-conformity in our processes, which is great. And therefore, I kind of then went, yeah, but hold on. I'd also done this because I wanted people to see recognition of it, and also possibly my insurers to look at me and go, well, you're obviously a good egg. You know, you're obviously really care deeply about not only doing a good job, but you're opening yourself up to be externally scrutinized, like you were just mentioning with Lexel. But we didn't get any benefits, you know. So because actually, you know, therefore you know, internally I just went, well, maybe that's a fee. I'm not like, it's not that I'm absolutely sure if they came in today, we could reopen up our doors again and be inspected and still not, hopefully, touch wood, not even have a minor non-conformity, let alone a major one, because we've maintained those processes and procedures, even though we don't ask them to come in any longer, because we just feel that's good business. But yes, we didn't get the benefits. So I suppose what you're saying is that these kind of, the standard, maybe the British standard is the one, I don't know whether it is, but, or even build upon that, is to say, right, okay, we've got to have some kind of way of getting the good firms to get scrutinised, but then the payoff is possibly more compliance or better PI cover at a reasonable cost.
Yeah, and that's why we need the insurers to have to take responsibility, because at that point they will take more interest in whether you're a certified financial planner or whatever it is, out of interest, actually. My view, my experience is that I have never sued a certified financial planner.
Right.
And I know you are one.
Yeah, interesting.
So for me, that is a fabulous standard that is the best kept secret.
Yes, very interesting, isn't it? Very interesting. The other, the other thing what was I thinking? Let's move to consumers listening to this and thinking, right, okay, I don't want to see 450, 500 million pounds worth of claims next year, right? I want consumers to be really smart about how they get advice and also the things that they get into. Therefore, they're so kind of buyer beware. They've read the Which magazine to getting financial advice or something. I don't know, but they've got enough. They've been given enough education not to know pensions legislation inside out, not to know the investment markets inside out, but they've got enough to know whether they're having the wool pulled over their eyes. How can we do that?
Do you know what? I think it's a really hard thing. If I had £1, Justin, for every person that had said to me, I wish I'd asked more questions. And I have acted for teachers, mechanics, CEOs of large supermarkets, hedge fund managers. I have acted for highly educated, highly experienced people, and people who are what you'd probably call vulnerable. They all say the same thing to me. I wish I'd asked more questions, but I don't know whether there are the questions. If I went to see the doctor, do I know the right questions to ask the doctor? Probably not.
No.
Why is always a really good question. Tell me more about that is a really good question. What else could I do is a really good question. We've only talked about one option here. What are the other options? Just broadening out that conversation. But if I'm really honest with you, I think it's really hard. It's really hard for consumers. If someone's talking to me about my Wi-Fi, do I know the right questions to ask? No, I do not. Even if I ask them why, would that mean anything to me? Probably not. So I suppose make sure you're listening, make sure you're reading the stuff you're being sent, and if you don't understand it, don't sign it. So I see lots of people who are sent letters, a signature page along with their suitability letter or their reason why letter. I haven't understood this. You don't know whether you understood it. Of course you don't know whether you've understood it. I mean, it doesn't really mean anything because that's more for the advisor feeling better about themselves. I would always advise people to be curious. I mean, being curious is a really good thing to be, and do try and make sure that you are comfortable, that you understand. But is there a silver bullet question that you can ask? I don't think there is. A lot of people don't want to appear like they don't understand things. So I think sometimes people do nod when perhaps they should be asking questions. So being curious doesn't mean that you're stupid. It doesn't mean that you're incapable of understanding. But if you genuinely don't understand something, don't nod because you feel a bit silly about it. Some people find it quite hard to be interested. I know it comes as a shock to you, but some people find it hard to be interested. They just want someone to sort it out. Whilst they do the stuff that they are really interested in, and I get that. And what I do see, there can be a bit of a gender imbalance, and so I do see quite traditional partnerships where the male will generally be the major breadwinner and will be signing stuff, and the wife will be brought in to sign things. Like, if you are the wife, be interested, ask questions. This is your money too. Don't be patted on the head.
And quite often it will be your money. Based on mortality statistics, the gentleman is going to go first. If it's a male-female couple, that's what's going to happen. And therefore, the widow left behind could be looking after that money for some years to come. And that's our experience working with retirees. We're always very, very conscious. And we are sure we're often selected because the one client is thinking, can you work with who I leave behind? Can I trust you to be looking after who I leave behind?
And I'm sure that's a very, very present in their mind, that they want that to be sure. One of the interesting things, just looping back to what you said right at the beginning, which was about culture. That may be a good signal somehow. So try and I don't know how you measure it, but somehow when you are engaging with a firm, try to assess what their culture's like. And again, I don't know what the questions that you would particularly ask, but I think people get a sense when they come in and see us and they meet everyone and they, I don't know. I think there's a feeling that they can get and go, okay. And if you can demonstrate, maybe, and we know it's not all about qualifications and tickets, but if they can demonstrate that they've spent some real time thinking about that customer journey, the how they can improve the work that they do, how they can get accreditations, how they can become chartered and CFP, how they can become accredited firms, whatever it may be, get British standards, whatever it may be. But look at that. Look at the way they're acting to see is that culture embedded in them looking after us rather than just getting a sale.
If your advisor isn't taking the time to explain that properly to you, that's probably a red flag, isn't it? That is trying to get it over the line. I've seen boiler room tactics, sending round motorbikes to people's houses with a courier. Please sign here. Don't do that. I can't imagine a scenario where you really need to do that. So if you're being put under pressure to do something, generally that's a bad idea. Yeah. How you measure somebody's culture is really hard, isn't it? I think that's really difficult to measure. I spoke on culture to a group of firms, and one of them was saying they'd gone for an interview at the firm, and they were sat, and it was a slightly earlier interview, and they were sat in reception, and every person that came in to work there saw them waiting and said, "Oh, hello, how are you doing? Has somebody got you a cup of tea?" And actually, it's the little things like that, I think, that do give you that good feeling around, actually, people notice things around here. They care about things. They care that somebody's looked after me and got me a cup of tea. It's not a panacea, but for me, that culture piece could not be more important.
No. Wise words. Thank you, Philippa, for your time this morning. I could talk to you for hours, and I know your time is extremely valuable. I look forward to seeing you again, and thank you for your words of wisdom.
No problem at all. Lovely to talk to you.
Thanks once again to Philippa for chatting to me today about the amazing work that she does. To find out more about Philippa and what we've discussed today, head over to the show notes on our website at theretirementcafe.co.uk, where you will find some useful links. Remember that if you prefer to watch my conversations, you'll find them on my YouTube channel, Justin King MFP, along with a whole series of other videos to help you plan for and live a successful retirement. So until next time, I'm Justin King, helping you feel more informed in your retirement.